Hello, everyone, and welcome to the latest edition of the LPL Market Signals podcast. Jeff Bookbinder here, your host for today, with my good friend and colleague, Mark Zabicki, standing in for Ryan Dietrich. Mark, how are you today?
Doing well, Jeff. Great to be with you.
Well, good. So, Mark, this might be surprising for you to hear, but I'm glad Ryan's not with us because, to be honest, I'm mad. I'm mad at Ryan. Because last week after the podcast, he said, "Oh no, I forgot to brush my hair."
Oh, based on that, I'm mad as well.
So we are both mad at Ryan for rubbing it in that he has hair and we don't. So let's get right to it. We'll first show you these lovely disclosures. Here's what we're going to talk about today. 3 topics: the slowdown in economic growth, which was the topic of our weekly market commentary for this week, posted on LPL.com yesterday, Monday. We're recording this Tuesday morning. Topic number 2, inflation. Be no surprise that we are talking about that today because it is CPI day. Of course, the question everybody's asking is this the peak? Based on the market rally after the hot inflation number, maybe some folks are voting with their dollars and saying a peak is in. So we'll weigh in on that. And then lastly, it's earnings season this week, the sort of unofficial start of it. So we'll do a little bit of a preview there. So let's just start with the broad market here, Mark. We got, it's been a very bumpy, certainly, market here lately. We rallied, about 9-10% off the lows, and now we're kind of rolling over. My question to you is, do you think based on this setup, are we going to go back and retest those lows from a few weeks back, or do you think we can hold on to, most of that bounce we got in March?
Jeff, excellent question. I wouldn't be surprised if we do, in fact, retest those lows. I mean, I think we started kind of talking about this year, really a year where directional change may be the kind of the operative phrase. And, we're going to talk a little bit about the GDP expectations here at LPL Research and the directional change there, and then the directional change in the Federal Reserve tightening policy, perhaps a little bit more robustly in the coming months. With that comes uncertainty, right? And that uncertainty has led to, a more volatile market to start the year. And the Russia-Ukraine issue has just kind of raised that bar in terms of volatility. So, I don't think we're done yet with the equity market weakness. So a retest of the lows would not be surprising.
Yeah, I tend to agree, Mark. The house view here at LPL Research is, still overweight equities, but very modestly, and certainly reflecting some caution here about the near-term outlook. And, although we're getting a nice bounce today, certainly I think, our technical folks, Ryan and Scott Brown would tell you that this is a sloppy chart, and it tells you that maybe we need to be temper our optimism about the very near term. Certainly one of the reasons people have been cautious about the market is because of the yield curve inversion. We think the 3-month 10-year Treasury curve is more important as a recession signal than the 2-year 10-year, but this is what everybody's talking about. So just want to reiterate this point that we've made in recent publications and on the podcast last week, that just because you get a 2s, 10s inversion doesn't mean recession's happening soon. So you can see here on the screen, on average, you get about a year and a half, sometimes as long as 2 years or more, lag between the inversion and the actual recession. So we think that's going to play out again, and there's going to be a good bit of time between this inversion we just got and recession. And then during this time, you typically get a really nice rally in stocks while you're sort of waiting for that bull market peak and then subsequent recession. So you see here on average almost a 30% gain on average over these last 4 yield curve inversions over that roughly on average year and a half period. So Mark, you think that's going to play out again where we've got more gains to come and Still time before we get the next recession?
Yeah, I think so. I mean, although we've started out a little rocky in the year, as we mentioned, I don't think we're done for the equity upside for the year. Consequently, we are slightly overweight equities. We did, reduce that equity weighting just a short time ago. Then we've got this subsequent weakness here that we're talking about, and perhaps a retest at the lows. But I don't think that we're done. Economically, I think we could have a little bit of a rebound in the second half. We'll probably get into that this morning. And, looking at the leading economic index overall doesn't really signal any type of a recession concern or any reason to kind of run for the hills in terms of your equity market exposure.
Yeah, certainly the credit markets are telling us that the economy is still in decent shape. Normally, if recession fears were warranted, you would start to see credit spreads widen out more than they have. So that's certainly something we continue to watch closely. And I'll also real quickly want to remind folks that April's a really good seasonal month. This from Ryan, 15 out of 16 Aprils have been higher, which is really amazing, frankly. We're down about 1% April to date if you factor in Tuesday's gains in S&P futures. So got a good chance of having a higher April again. Certainly we know the challenges, and we're going to talk about a few of them here in just a moment, but looks more likely than not, based on history here, that we'll end up in the green for the month. So let's turn to the weekly market commentary, Mark. The headline is Headwinds to Global Growth. And we all know that. Our economist, Jeff Roach, has taken down forecasts for U.S. GDP twice now. We started the year north of 4. Now we're closer to 3. And then with that certainly comes lower growth expectations in Europe, in China, frankly, and Japan. Really, everybody's fighting inflation, right? And everybody's feeling the pain of the Russia-Ukraine conflict, although to varying degrees. Frankly, I mean, we're not the only economy seeing higher wages and companies seeing margin pressures from that environment. So, I guess the question is, and this is what Jeff wrote in the weekly, could we see a second half rebound? Or should investors just expect this lackluster start to the year to mean that we're going to be kind of, flattish and skirting on the edge of recession, for the next 8 months?
What Jeff Roach and Lawrence Gillum wrote in our latest weekly market commentary, Jeff was indicating that perhaps second half of the year you get that transfer or that baton pass, if you will, between kind of the consumer spending from a kind of a product perspective, and then more of a services perspective. Actually, as it kind of stands to reason as people kind of get out and enjoy their summer vacations, perhaps do a little bit more spending on the services side of the economy. That's what Jeff expects to really carry the load. In the second half of the year, I think there'll probably be some improvement from a geopolitical perspective in terms of the way people think about it. Perhaps I don't know that sanctions are going to be reduced anytime real soon. But the hit to the economy based on the Russia-Ukraine conflict is certainly going to be felt more strongly in the first half of the year, and maybe we can improve off of that hit in the second half of the year. But the numbers indicate, in terms of our recent, forecast, 2.7% in the U.S. to 3.2%. That is certainly not a robust economy effectively, certainly higher than our normal growth pattern in the U.S., which the CBO will tell you it's around 1.5% in kind of a normalized growth environment. So higher than that, but not necessarily robust. And Again, back to that directional change issue where, you're getting a degradation in the trend of a GDP growth in the country and then also in the world. And that's had some effect clearly on the way people think about capital market exposure.
Yeah, there's no doubt that this economy is slowing, not just the US, but also globally. But a number of these factors, I won't say the bad word transitory. We know the Fed doesn't like that and got in trouble. But there's certainly a strong likelihood that these supply chain pressures ease in the second half of the year. Hopefully China gets the COVID situation under control over there and they can start to more fully reopen. We know that the US is pretty fully reopened and we're starting to get more labor force participation. And we certainly hope and pray that we can get a ceasefire in Ukraine and that can help ease the pressure on commodity prices. So these things are really, it's a perfect storm right now, no doubt. And that's why we just got, an 8.5% CPI print, but there's no doubt that the prospects for those factors to revert are pretty likely. We don't know the timing and, who knows exactly how long that takes, but we could be set up for a really nice rebound. And then if you get business confidence back, right, which Jeff points out in the commentary, we could actually see business investment contribute to that second half rebound, in addition to hopefully consumers spending a little bit more as inflation eases.
Yeah, we got the NFIB Small Business Optimism Index, and it's lower than expectations this morning, but it is at a high level. If you look across the construct of ISM manufacturing and services, again, those numbers are weaker than they have been, but still at a fairly robust level. And again, the leading economic indicators are not showing any kind of real signs of concern. Non-farm, payrolls relatively strong, jobless claims at low levels, average hourly earnings still relatively robust, although again, down from peak levels in the post-COVID era. So not a whole lot to point to that's drastically negative from an economic perspective, over and above what most people have been talking about over the last couple of weeks, which is credit spreads, is a leading indicator that's providing some level of caution.
Yeah, and last point on the services spending piece, Jeff points out that we actually have $500 billion of upside potential in spending on services if we return to the prior trend. That is a big number. In fact, I think it's almost 3% of GDP, which is, we're not necessarily going to get that this year, but point is there's a lot of runway on services spending in the US to potentially get us to that 3% GDP number, which, as Mark indicated, is a pretty good growth rate in this economy. We also make the point in the weekly commentary that consumer confidence has declined sharply, but that doesn't necessarily mean we're going to have a recession. For those watching on YouTube, you see the orange boxes reflect mid-cycle slowdowns where we saw big drops in consumer confidence, but we did not get a recession for several more years. The mid-'80s and the mid-'90s are those periods. So the question now, Mark, is, are we going to get a repeat of that? Is this big drop in consumer confidence? And we all know it's about high inflation and to an extent, the geopolitical concerns and COVID. Are we going to get a repeat and could we see a big bounce in confidence over the next several years and stave off recession?
Yeah, I think a lot of it has to do clearly with the geopolitical condition. Perhaps in the second half of the year, again, if we get back into more of a services spending mode in the second half, people taking vacations effectively, I think consumer confidence can stabilize. We are at relatively high levels in consumer confidence as the chart shows. So there's no severe concern. As a matter of fact, I think we could probably expect consumer confidence to tail off based on the peak that we went through post-COVID. So the fact that we're getting some deceleration in consumer confidence is probably not a surprise. And I think there's a high correlation between the jobs market and consumer confidence. So while we're getting this volatility near term, the jobs market shows no reason for consumers themselves to be that concerned.
Yeah, this is actually a pretty resilient picture of consumer confidence given the environment we're in, because nothing affects people more across this country than inflation. If you want to pick sort of one economic environment, inflation and unemployment maybe would be the two that affect most everybody when they go bad. So this is actually a pretty confident consumer still. Actually, if you survey investors, I saw the Bank of America Global Fund Manager survey. Economic pessimism is in line with 2008 levels. Okay, so there is a lot of pessimism. My contrarian alarm bells go off. I know Ryan Dietrich has a contrarian alarm bell and tells me that maybe the pessimism has gone a bit too far about the economy, at least among investors surveyed, mutual fund managers in that survey. Certainly, I agree with you, Mark. Consumer confidence probably comes down, but we have the makings of a second half recovery with inflation easing, no doubt, because that's clearly the biggest factor right now for consumers who are expressing some discontent, I guess, with the economic environment. So let's good discussion, Mark. Let's transition into inflation. We just got CPI this morning. You really, I always say this, you really got to peel back the onion, because if you just see that 8.5% number, clearly that's an increase month over month. That is a really, really high number. This chart reflects the February number. So we've just gone up another half point roughly. We haven't seen anything even close to this since the 80s. We all get that. But the market's rallying on this. Right. So, Mark, what's the market seeing here? I guess maybe sniffing out a peak that it's getting excited about today.
Yeah, I mean, the year over year all in numbers, up 8.5% from March. Ex food and energy is up 6.5%, which is actually a tick lighter than the survey. The Bloomberg consensus survey was 6.6%. For CPI ex food and energy, so perhaps there's something to get excited about there. I do think, and Jeff writes about this in the weekly market commentary, that inflation is likely, we believe, to peak here sometime soon in the coming months. Could it be April? Could it be May? That remains to be seen. And the inflation issue is very interesting, to me, as it is to most people. And I think the expectation around inflation is when you get a economy that was basically shut down and then turned back on like that, and then like that, there's really no surprise that you're getting inflation. And then couple those issues with supply chain issues that still are with us today, couple those issues with, stimulus spending, which is perhaps a little above board in terms of, I think, that the way I think about it. So, I mean, the fact that we're getting inflation is really no surprise given the circumstance that we've witnessed with this economy, historic circumstances. I believe longer term that there still is disinflationary pressures in this economy that is actually going to allow inflation to roll over. We could perhaps, transitory is now a bad word, but I mean, it's transitory for longer than we actually thought it was going to be transitory for. But I don't know that we're going to be, with CPI readings over the intermediate term with 6.5%. I do in fact think we are going to roll over. And I think that is actually going to be a catalyst for the equity market in the second half, as well as some earnings that we'll talk about, Jeff. But those are two things I think we can point to that that lead us to believe that equities still have room to run.
Yeah, at least for I agree 100%, at least for the CPI, the shelter component's really important. That was a big driver of the increase in March. So keep that in mind. Certainly gasoline prices and food prices, as we know, those are up a ton and have certainly high potential to level off and even start to decline. And then keep an eye on used car prices. They're up 35% year over year. That's just not normal, not sustained, will not be sustainable. So some reversion on that as we get more semiconductor supply, more car supply, that will certainly, we think, come down. And then last point on this, which is a really important one, we have had inflation fall during periods without recession. And so certainly 2014 is a good example of that, right? 2014 inflation came down. You can actually see that on this chart. We didn't go into recession, certainly, didn't for a while, and it was clearly COVID driven. So, hopefully we get a repeat of that. Again, falling confidence and falling inflation don't necessarily mean recession. So let's go. You mentioned it, Mark, the, earnings. This is the week where we get some of the big banks later in the week, a small smattering of companies in other industries, a little bit of airline reports, which will be interesting. Certainly they're having a very tough time, as we're all aware, but really it's about the banks. So, high level, we think we're going to get a good earnings season, but you're going to see some drag from the financial sector. Consensus right now is about 5% year over year in Q1, which is a huge slowdown from the massive earnings growth numbers we saw last year. Of course, that was coming off of lockdowns. And if the economy shuts down, growing earnings sharply off of those very depressed levels is certainly very easy. So now we're kind of in a more normal environment. If you get the average upside that we've seen over the last couple of decades, then we're looking at maybe 9% earnings growth, which would be pretty good given the challenging environment. So Mark, do you think we can hit that? Or do you see something that worries you and suggests maybe, we won't get any upside at all?
Yeah, well, I mean, I think the inflation issue worries me, and how corporations deal with that. And, of course, margins are still relatively robust. I mean, and Jeff, you and I and a group of us here at LPL Research were talking about the earnings outlook in our strategic and tactical asset allocation committee, and I think we were surprised at the strength in earnings, or at least the setup in Q1 earnings, as we get started here. So I've been, a little bit surprised for the last, 6 quarters, if you will, and what, U.S. corporations have been able to turn in terms of earnings growth. You would think that they kind of run out of steam, but I mean, a 5% earnings growth number in Q1, while certainly doesn't match the Q1 of last year, it's still a pretty strong number. Margins are relatively strong. Again, I think this is one of the things that we can point to as a catalyst for us to be still overweight equities, cautiously overweight equities, but still overweight. I mean, as long as these companies are reporting good earnings, margins are relatively strong. It's an environment where stocks can continue to do well.
Yeah, and despite stocks being down year to date, they've done better than bonds. So that overweight equities has surprisingly still worked, even with stocks down a few percent year to date. So yeah, I think I am surprised, frankly, that earnings have held up as well as they have. Not only have we seen massive upside that really few, if anyone, expected in recent quarters, but the estimates for 2022 have actually risen this year. They're up about 2%. And frankly, make our $220 estimate for S&P 500 earnings this year look conservative. Consensus is 228. right now. So we'll probably have to raise that forecast. That uptick in estimates suggests confidence with not just Q1, but for the year. We've seen Q1 estimates dip just a smidge leading into the quarter. That's historically what happens. It hasn't fallen as much as it historically has leading into the quarter, but that suggests maybe, we'll get average upside, possibly not more than that. So that's what puts you in that kind of 8-9% range for a reasonable expectation, we think. Now, keep in mind, that's the long-term average. If you go back, as long as earnings for the S&P 500 have existed, the average growth rate's about 8-9%. To do that in this environment where people can't find labor is extremely expensive. There are shortages of materials. The supply chains globally are snarled. We have a devastating war in Ukraine. China's in lockdown. I mean, you go on and on and on. These are just really stiff headwinds, real big challenges for corporate America. And yet there's a very good chance we'll get average earnings growth, which would be a victory in my book. So we think we'll get a good, pretty good earnings season, but there are headwinds. And then, by the way, another headwind, financials are one of the biggest earners in the S&P 500. They had huge reserve releases for the banks a year ago. Again, coming out of lockdown, they massively reserved for potential losses. Those losses didn't come partly because of the stimulus and the vaccines. And then we ended up with, these massive gains in profits for the banks. Fast forward a year, growing off of those quarters is going to be very, very difficult. So financials earnings are expected to be down double digits, and yet we still could see high single digit overall S&P 500 earnings growth, despite that headwind. Now, one of the reasons we're not going to see an earnings decline overall, despite that financials weakness, is because of energy. So, Mark, we're going to get, quintupling, tripling, something massive in earnings for the energy sector. That actually could be worth 5 points by itself. So how should investors think about that? Do they discount the earnings growth and say it's not real because energy doesn't count? How should people think about that?
Well, that's a good question, Joe. I think it clearly counts, but I think you just have to be a little bit careful of hanging your hat, solely on the earnings picture relative to what we're seeing out of energy, because we know the commodity markets can turn rather drastically, and all it would take perhaps is some semblance of a geopolitical cleanup in Russia and Ukraine. Not that we're forecasting we're going to get that anytime real soon. But yeah, I mean, when you're dealing with energy and other materials that are portions of the S&P 500, for example, that are beholden to commodity prices and the movement therein, there is a little bit of a pause that you have to take into account in terms of the longevity of that commodity price trend. I mean, commodity prices could be coming off a long-term floor, a multi-year floor here, and strengthening to a long-term positive trend. I think the jury's still out on that, but and China has a lot to do with that. But it's the earnings are good. Period. The earnings from energy is a little bit cautious. I don't know that I would want to rely on just energy earnings on a go-forward basis in terms of how we feel about the equity market in general. But I think we'll take it while we can get it there, Jeff.
Oh, no doubt. Yeah, if people want to do X energy earnings, and you end up with something pretty low, fine, then take out financials too, because there's some unique characteristics to the financials year-over-year comparison as well. Actually, the SPAC boom from last year too is a difficult comparison. All the underwriting fees from that special purpose acquisition companies. So that's that's kind of a high level on earnings. We'll talk more about that next week. But let's get into the economic calendar a little bit. The inflation number we just got this morning is the highlight of the week. Tomorrow we'll get producer prices, and that's it. That story will be similar. That maybe this is a peak. What about retail sales, Mark? I mean, it seems to me we've taken expectations for growth down. Consumer is struggling with high inflation right now. We certainly see that when you look at consumer confidence. Should we expect a weak retail sales number?
Well, I think that's going to be closely watched, and I think if you get a weaker than expected retail sales number, so probably for the rest of the week, retail sales is probably going to be the most important on Thursday, and then industrial and manufacturing production would be my guess on Friday. But if you get a weak retail sales number, then people are going to kind of parlay that into the inflation pressures that consumers are seeing, and just the general pause as is associated with kind of the geopolitical tensions we're facing. So that could be a weak number, could be a little bit of problem for the equity market in the near term. But again, based on some of the comments from Jeff Roach, I mean, I don't know that the retail sales is going to roll over and die for the rest of 2022. So it may just be short-lived, perhaps, based on inflation and geopolitical tensions.
Yeah, remember the retail sales numbers are not inflation adjusted, so they get a boost from higher inflation. They get a boost from higher prices, but the inflation piece will essentially erode it and end up with probably not much growth, or maybe even a little bit of a month-over-month contraction after you adjust that. So thanks for those comments, Mark. Let's go ahead and wrap here. We're at time. So thanks everybody for listening. As always, Brian will be back next week. I'll actually be out next week. So Mark, maybe you get to do it again and yell at Ryan for that insulting comment about his hair. Certainly more talk on earnings season, which is going to be the topic of next week's weekly market commentary. So Mark, any closing remarks before we wrap?
Well, we'll go easy on the references to the hair perhaps next week. So hopefully Ryan will be back, and whether I'm in this chair or not remains to be seen. But yeah, it's going to get interesting over the next couple of weeks as we get the earnings figures. And we get some expectations around what inflation could set up and look like over the coming months. So it's turned out to be much more of an exciting year in 2022 than it was in 2021 when everything was going up in a straight line.
Yes, interesting, no doubt. So thanks again, everybody, for listening. As always, to our latest Market Signals podcast. We'll be back with you next week, and looking forward to talking to you then. Take care, everybody.